General observations. A sharp bullish reversal, where X precisely marks the spot where long-term sentiment changes. The uptrend has now been reversed by a flatter head and shoulders formation. It highlights the usual neutral to bearish price action after a clear uptrend line has been broken. Due to the exceedingly long lower wick in mid-December, there is a minor delay in the drop after the neckline break. The head and shoulders range lines up with a large declined double top for extra validity of this long-term resistance range. Like normal, there are helpful downtrend lines from the head and shoulders as the drop continues. The overlapping outlines of a descending triangle and horizontal resting phase range sustain the downtrend along with constant selling volume. This is due to the slight decline that emerges from February to March on the same approximate trajectory as the downtrend lines from the head and shoulders. Similar to before, the crossing of trend lines marks a significant bullish reversal with an X, except this is from a flatter double bottom. Although the uptrend line has been broken and there has been years of bearish background, the past few years have seen considerable progress in a bullish recovery. The overall uptrend is still intact, both from late 2002 and the more recent double bottom reversal. When selling pressure decreases in early November, the general upward trajectory resumes. Then, as usual, the major resistance range now becomes a key support. In December, there was another compact formation with features of a triple top and head and shoulders. Moderate selling pressure was repelled into the new year when the 40 boundary held as the new lower boundary. The 40 boundary also becomes the neckline range in a larger failed head and shoulders outline. Although the head and shoulders failed, a minor double bottom reversal was soon countered by continued resistance and the bearish acceleration of a descending triangle. Naturally, a large drop takes place after the key 40 boundary was breached, but the lower ranges in the mid-30s still managed to be helpful in identifying progressively stronger support. Since this was an example of an ETF that tracks a major stock market index, the chart generally had more stable and longer-lasting bullish and bearish trends compared to most charts of individual stocks.